U.S. government shutdown and missing jobs report. This week marks the third day of the government shutdown, and the impact is already hitting the economy. For the first time in years, the Labor Department has failed to release its monthly jobs report. That's not just a missing data point. It's the single most important report Wall Street, the Federal Reserve, and policymakers rely on to gauge the health of the economy. And right now, we're flying blind. Economists say the timing couldn't be worse. The U.S. labor market has been cooling after a surprisingly strong summer. Private data from ADP shows that in September, American businesses actually cut 32,000 jobs, the weakest showing in more than 2 years. Normally, the official BLS report would confirm whether this slowdown is real. But with the government closed, investors are forced to rely on scattered private surveys and corporate announcements. Another red flag: planned hiring is collapsing. According to Challenger Gray and Christmas, companies have announced only about 205,000 new job openings so far this year. That's down nearly 60% from last year, and the weakest since 2009 during the Great Recession. In other words, businesses aren't just slowing down hiring now. They're signaling less demand for workers in the months ahead. And jobs data isn't the only casualty. If the shutdown drags on, the government will also delay two critical inflation reports: the Consumer Price Index updates in mid and late October, and the official GDP estimate for the third quarter. All of these are vital inputs for the Federal Reserve, which is just weeks away from deciding whether to continue cutting interest rates. Without official data, the Fed is stuck in an extraordinarily difficult position. So what does Wall Street think? According to Reuters, the probability of another Fed rate cut this month is now very high. Bank of America and other firms have already shifted their forecasts, betting the Fed will move sooner rather than later. But making that call without hard government numbers is risky. How much damage does a shutdown actually do? Historically, short shutdowns barely leave a dent, costing about 0.2 percentage points of GDP per week. Losses that are usually made up once the government reopens. But this time could be different. If the administration moves from unpaid furloughs to actual layoffs of federal workers, unemployment will rise, and the ripple effects will spread across the economy. Already, the travel and tourism industry is warning of nearly $1 billion in lost revenue per week. Another concern is the information fog, now covering financial markets. Normally, investors and traders anchor their week around Payroll Friday and inflation reports. With those missing, analysts are piecing together the economy from smaller surveys and private payroll releases. That raises the risk of misreads and overreaction in markets. Still, not everything looks grim. The S&P 500 has just hit an all-time high, suggesting that investors are betting on a so-called soft landing. Where inflation keeps easing, the Fed offers support, and growth slows but doesn't collapse. Yet analysts warn that optimism could prove fragile. Tariffs are still weighing on manufacturing, corporate debt levels remain high, and without reliable federal data, the picture could change quickly. So, what's the bottom line? First, the shutdown has frozen the government's most important economic reports, leaving America flying without instruments. Second, private data is already flashing warning signs. Job losses at ADP, the weakest hiring plans since the Great Recession, and falling business confidence. Third, the Federal Reserve will likely err on the side of cutting rates, but they'll be making that call without a full view of the economy. And fourth, time is the real risk. A short shutdown is a nuisance. A long one could push unemployment higher, squeeze small businesses, and spook global markets. What to watch next? The duration of the shutdown, any stopgap data from regional Fed banks or private surveys, the Fed's next decision, and whether companies start freezing job postings ahead of the holiday season. When the government finally reopens, the flood of delayed data could either reassure investors or deliver a nasty shock. For now, the message is clear. The U.S. economy is slowing. The shutdown is blinding policymakers, and the stakes are rising by the day.